What's the difference between short-term and long-term capital gains? Let's talk about it. When you sell an investment for more than you paid for it, your profit is considered a capital gain. If you held the asset for a year or less, that's a short-term capital gain. Any profit made after that time period is considered a long-term gain. Capital gains qualify for special tax consideration, so it's important to understand the differences between short-term versus long-term capital gains and the ways in which you can minimize their effect on your tax bill. So what are capital gains? Capital gains represent the positive difference between the purchase price of an asset and the sales price of an asset. If you buy an investment for $100 and sell it for $150, for example, your capital gain is $50. Capital gains apply if you sell assets such as stocks, bonds, jewelry, real estate, collectibles, precious metals, or other investment vehicles for more than you paid for them. So then what's short-term versus long-term capital gains tax? Capital gains are subject to federal taxes, but the tax rate depends on whether it's a short-term or long-term capital gain. To quantify how long you've held an asset, you will typically count from after the day you acquired it and including the day you sold it. For short-term capital gains tax, these gains are taxed as ordinary income, so they will be taxed in whatever federal income tax bracket you fall into. Long-term capital gains tax, these gains are taxed at either 0%, 15%, or 20% depending on your annual income. Because short-term capital gains are taxed as ordinary income, they'll be taxed at your marginal tax rate. Meanwhile, your long-term capital gains rate will depend on your annual income and filing status. So calculating your capital gains isn't too complicated. Here's how it works. First, consider how long you've held the asset. Figuring this out will help you determine whether it should be taxed as long-term or short-term capital gains. Number 2, figure your basis. This will typically be the purchase price plus any fees or commissions you paid for the asset. Number 3, figure your realized amount. This will be the sales price less any fees or commissions paid. Number 4, subtract one from the other. Subtract what you paid from your sales price to get the difference between the two numbers. If you sold the asset for more than you paid for it, this is a capital gains. If you sold the asset for less than you paid for it, it's a capital loss. Number 5, find your tax rate. Based on whether it's a short or long-term capital gain, find your tax rate based on your taxable income. And number 6, apply the tax rate to your gain. Multiply your capital gain by your tax percentage to determine how much tax you'll pay on the proceeds. So let's go with an example. Suppose you purchase 100 shares of stock priced at $50. Your total purchase price is $5,000. 2 years later, you sell those 100 shares of stock for $75 a piece, for a total sales price of $7,500. Your capital gains, long-term in this case, is $2,500. Assuming you are married, filing jointly, with taxable income of $150,000, your long-term capital gains rate tax would be 15%. $2,500 gain times 15% tax rate equals a $375 capital gains tax payment. This may vary based on any fees or commissions paid. Remember as well that an increase in value of an investment isn't generally a capital gains until you sell the asset. If you purchase 100 shares of stock at $50 per share and a year later the stock is priced at $100 per share, there is no capital gain unless you sell the stock. But there are exceptions to typical capital gains tax rates. Capital gains on real estate work slightly different than capital gains on other assets. Your tax bill will depend on whether the real estate is an investment or your primary residence. For any real estate other than your primary residence, you will pay capital gains taxes on any profit you realize when you sell the property. If you buy an investment property such as a rental building for $400,000 and sell it 5 years later for $475,000, you have a capital gains of $75,000, and you will pay long-term capital gains on that. If you've taken depreciation deductions that lower your cost basis, you'll also be taxed on depreciation through what is known as depreciation recapture. There are different rules that apply to capital gains on your primary residence. The short and long-term tax rules are the same, but each individual gets a $250,000 exemption on capital gains before they owe any taxes. If you're a married couple, that means you can exclude up to $500,000 in capital gains when you sell your house. You can only claim this exemption once every 2 years. It's also worth noting that any improvements you've made to the home can be added to the basis. So if you bought a home for $200,000 and you've done $50,000 worth of home improvements, your new basis for purposes of capital gains calculation is $250,000. In order for your home to qualify as your primary residence, you must have lived in and used it as your main home for at least 2 of the previous 5 years. If this is not the case, you are not eligible for the tax break. So what about capital gains on collectibles? Some people buy and sell collectibles such as art, coins, antiques, or jewelry. Capital gains on collectibles held for more than a year are taxed at a maximum 28% rate, no matter what tax bracket you're in. So how about net investment income tax? Investors with a high net worth may also experience different capital gains rates. People with income over a certain threshold will see their capital gains subject to an additional 3.8% tax. That threshold, if you're single, is $200,000 per year. So then here are 5 ways to minimize or avoid capital gains tax. Number 1, use capital losses. If you have capital losses, meaning you sold an investment asset for less than you paid for it, you can use those losses to offset your capital gains for tax purposes. If you have $1,000 in capital gains and $1,000 in capital losses, for instance, you have no taxable capital gains. If you have more losses than gains, you can claim up to $3,000 of losses against your taxable income, carrying forward any excess losses to future years. Number 2, hold your investments. Tax rates for long-term capital gains are lower than those for short-term capital gains. Holding investments past the 1-year mark before selling will automatically result in lower taxes. Number 3, take advantage of tax-deferred accounts. You don't pay taxes on investment gains in a tax-deferred retirement account until you take distributions in retirement, and by then you may be in a lower tax bracket. If you're choosing an investment that might result in frequent gains or dividends, a tax-advantaged retirement account can be a good place in which to hold your money. For example, you can trade stocks in a retirement account such as an IRA without having to worry about paying short-term capital gains. Number 4, gift your winners. If you itemize deductions on your tax return, you can donate an asset with significant gains to the nonprofit organization of your choice. If you've got some low-basis stocks that you've held for 20 years, you can gift those shares, get that tax benefit, and avoid the capital gains you'd otherwise have it if you sold it. And number 5, execute a like-kind exchange. If you sell an investment property at a profit but buy another similar property soon afterwards, your capital gains on the first property won't be recognized. You must identify the exchange within 45 days and complete the transaction within 180 days to qualify. So what are your thoughts? How do you derive most of your income? If you like this video, hit that like button, consider subscribing. I talk about money and everything related to it, so don't miss out. And as always, take care of your money.